Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is Jonathan Twombly. Jonathan is a lawyer turned real estate investor. He spent 12 years as a Wall Street litigator. The last half of that, which he spent representing hotel owners in dispute with national hotel chains. In 2013, after leaving law and burning the boats, he formed Two Bridge Asset Management, LLC, to focus on syndicating, building a 400 plus unit apartment portfolio in South Carolina. Since selling those properties, he has co-GP'd on approximately $250 million worth of multifamily deals. He recently syndicated the purchase of a tourist hotel in the Finger Lakes area of New York State, which he's renovating and using as a starting point for a hotel brand, the Laurel Hotels. Two Bridge is a joint venture partner with a publicly traded Japanese conglomerate, Marubeni Corporation.
It's called Marubeni.
Marubeni Corporation. Okay. Yeah. Fantastic. And then finally, Jonathan hosts an apartment investment club podcast and runs a multifamily investment mentorship program under the AIC label. So, Jonathan, welcome to The Wealth Flow.
Thank you very much. Thanks for having me.
Yeah. And I like to, as we were talking a little bit about before the show, I like to really start with kind of where you grew up. And, I know your career took a little bit of a turn before real estate. And so I'd like to hear a little bit about that. What led you to real estate investing?
Yeah. So, I grew up in the New York City suburbs in northern New Jersey. Mom was a school teacher, kind of grew up around everybody who is, not just, like W-2 jobs, but they all work for the government in one form or another. So there was no real kind of entrepreneurial, I did not grow up in a household of like business people or entrepreneurs or anything like that. Although my grandfather was a business owner, and so maybe it skipped a generation. I don't know. But I grew up, like I said, in New York suburbs. Always kind of had like a standard sort of career path in mind. I was at some point I decided to become a lawyer and, did the whole thing, went to law school, became a lawyer, worked on, for a number of Wall Street firms. But that is, for anybody who knows what that life is like, it is a tough life, right? It is not just that you're working for the man, but that you're working for the man like 12 to 14 hours a day, often 7 days a week. And there's not a whole lot left over to your life after you get done working for the man, right? So yeah. I got pretty burned out doing that and started kind of thinking about, well, what else could I do with my life other than this? And it took me quite a long time to figure that out. But eventually I did kind of settle on real estate.
Okay. And did you know other folks that were doing real estate, or what sort of opened your eyes to that world?
Yeah, I mean, I had always been interested in it, I guess, maybe, for the reasons that I think a lot of people are interested in it. It's very familiar. I mean, everybody deals with real estate, right? There's not a single, unless you live under a bridge, like you're literally involved with real estate
Yeah.
all the time, right? And so I think somewhere along the line, at a very young age, I kind of, I guess, became aware of the idea that you could make money in real estate, right? And it seemed pretty easy, right? It's like, hey, you own a building and people pay you rent. Wow, that's a lot. That's a pretty easy life. So when I was like struggling away as a lawyer, working these insane hours with all this stress, real estate started becoming this thing in my mind. Like, oh boy, that would be really nice to just like not have to work this hard.
Yeah.
But I didn't really know anybody who was in the business, and I didn't really know anything about it other than, I went to some seminars like fix and flips, and none of that really seemed like it was going to get me out of my job. I didn't really know how I was going to make $10,000. And this is back, 25 years ago. So, how I was going to make like $10,000 on a flip. And then that was going to somehow replace my, $200,000 a year salary. Right. So,
Right.
I couldn't really put those pieces together. But what happened was I just was getting to the end of my rope with my legal career. And then at some point, it also became clear to me that I was probably going to be losing my job, because this is sort of right after the financial crisis. The work had just dried up. I mean, there was just like no work to do. I was sitting at my desk doing nothing all day, making at that point probably close to $300,000 a year. And I knew that this just wasn't going to last, right?
Yeah.
And I didn't really want to go look for another law job. And I was like, well, I got to really start taking some action here and figure out what the next step is. So I started doing a lot of networking, and it wasn't like real estate related networking at all. It was just sort of general business networking. And every time I met somebody who was in the real estate business, I would ask them to coffee and try to figure out like what I could learn from them. And at the time, my idea was like, hey, well, I come from this corporate background. I'm just going to go work for a private equity fund or a hedge fund or something like that. That just seemed like the natural step for me. I never thought about going out and doing this on my own. But what I started hearing back from people was, hey, look, Jonathan, you've got a great resume. You got a great, background. I'm sure you can do this work. The problem is that at your age, nobody's going to want to hire you for essentially like an entry-level job. No 30-year-old manager is going to want to boss around a 40-year-old guy and, with kids at home and tell him to work late.
Yeah.
And plus, like, this is right after the financial crisis. So there's like 10,000 guys on the street who have been doing this for 20 years who are all looking for jobs now. So why is somebody going to hire you with no experience when they have their pick of like all these experienced people? So the only way that this is going to wind up happening for you is if somebody kind of takes a liking to you and offers to be your partner. So then what happened shortly after that conversation was I was doing all this networking, and somebody said to me, hey, well, I'm starting this real estate investment startup. How'd you like to be my partner? It was literally like what I had just heard from this other person.
Yeah.
So I thought, okay, well, all right, what should I guess I should kind of think about this. And so I didn't really know what else to do with that other than to take that person and trot them around to a bunch of my rich friends and say, what do you think about this person? I wasn't looking for money. I was like, I want you guys to tell me if this sounds legit to you or not. Right. So it was kind of like my way of doing due diligence on this person. And what happened was I trotted her around to a bunch of people. She gave her pitch. And what happened was they all said to me, well, listen, Jonathan, I don't know what you're going to do, but if you do decide to partner up with her, I'll give you money to invest. And it wasn't like, I'll give you $50,000. It was like, I'll give you $1 million to invest.
Oh,
right.
Wow.
So before long, I had raised, without even trying to raise it, a couple $1 million. And I had this offer of a partnership on the table. So I thought, maybe I ought to do this. And in the meantime, I'd actually had gotten laid off from my job. And I was kind of on severance at this point and just not interested in looking for a law job. So I thought, you know what? I've got money in the bank. I've got some runway. I've got this offer of, a couple $1 million to invest. I have this partnership offer on the table. Maybe I ought to do it. Maybe the universe is telling me something. Maybe I ought to do this. So I said yes, kind of signed up with her. And the funny thing was that I had, just since I live in New York City, and the whole real estate conversation in New York City was essentially like gentrifying neighborhoods in Brooklyn. Like that's kind of what like the sum total of real estate investment in New York City was for, unless you're doing it like on a corporate hedge fund level. But for normal people, it was all like trying to figure out where the gentrification was going in Brooklyn. And everybody was hearing these stories about, the people who bought their brownstones for $100,000 and now they're worth $2 million. And like,
Yeah.
I thought that was what real estate investment was. So, but instead I get to like my first day of work with my new partner and she's like, oh, no, that's not what we're going to do. We're going to go and buy 100-unit buildings in Louisiana. And I'm like, how are you going to buy a 100-unit building? And then she was like, no, like 100-unit, and this is, 12 years ago,
Yeah.
100-unit building in Louisiana, it's like $3 million, $4 million, right? It's like what you're going to pay for a brownstone, right? And like, I was like, wow, this really opened my eyes. So I learned the whole syndication business there. And from working with her, ultimately that partnership kind of fizzled out. But I spent a couple of years really learning the business. And when I went out on my own and formed Two Bridges in 2013, obviously those investors were mine that I'd originally kind of signed up. They came along with me, and that's when I really started to get some traction. I stopped looking at Louisiana. I shifted my focus to the Carolinas, and then it was kind of off to the races after that.
Yeah. Okay. And tell me a little bit on that, on this partner that you had. Did she have experience? I mean, obviously she kind of knew what she wanted to focus on, but did she have experience, or was this kind of new to her as well?
So she had some experience. She was married to a guy who owned a bunch of multifamily already.
Okay.
And he had essentially kind of tasked her with like, hey, well, you run this, right? You run my portfolio for me, right? And even they had bought a new property, and he'd been like, okay, this is your baby now. So she was kind of forced to learn very fast about how to run a property, but she really didn't know how to raise money. Not that I did, but I sort of accidentally did raise money. And she had envisioned it as being, and apparently like her husband had no interest in building a multifamily business. He's like, I own enough property. I'm doing fine, right? What do I need to work any harder for? But she wanted to build a business, so she needed to go find another partner. And she'd been to so she decided, she was like, well, I better learn about this. So she started going to real estate seminars. And I think that's where she learned about syndication, got kind of like the syndication bug. Mm-hmm. So she knew about the sort of property side. And it was kind of up to me to kind of figure out how to raise money, which ultimately I did, but it took a while. So,
right. So did she, did you have a certain company that you used for property management? Was it kind of specific to the various apartments and where they were located, or what did the structure look like when you were with her, and how has maybe that changed since you opened up Two Bridges?
Yeah, so the model was always to use local third-party management to actually manage the properties, and that really hasn't changed. That's still on multifamily deals. My model is to partner with local management companies. However, in the last couple of years, I've gotten into the hotel space, and on the hotel side, we're actually fully integrated, where we manage the properties ourselves. We have construction in-house. We do basically everything. So that's taken a little bit of a different turn than the multifamily did. But on the multifamily side, there are some people who do self-management when their portfolios are really small, but it's pretty much the consensus that it's not worth trying to take management in-house until you're up to a couple thousand units. It just doesn't really make sense before that. So, and a lot of people never get past that point, right? They'll use third-party management forever. but it really depends on what you're trying to accomplish.
For sure. And then, Jonathan, when you started TwoBridge, did you have another partner, or was this solely you? And I guess tell me a little bit about how once you decided to make that move and create this company, what did you buy first?
So in terms of the company itself, I did have another partner originally. It was one of my investors, and that partner was just silent. So it really was me just doing everything on my own. And the first thing I bought was a 102 unit C-class multifamily property in Spartanburg, South Carolina.
Okay.
So I shifted my focus to the Carolinas. I kind of got ahead of the game on that. I was really one of the first out-of-staters. Not that there was nobody from out of state investing in South Carolina, but it wasn't really on a lot of people's radar at the time. But I had noticed the demographic story that was happening in South Carolina. And I also just really liked Charleston a lot because I had friends down there and traveled down there quite a bit.
Yeah.
So I spent a lot of time sort of driving all over the state of South Carolina, looking at different markets, and really liked the upstate, as it's called, the Greenville, Spartanburg area. And it was really more accidental than anything else that the first deal wound up being there as opposed to the Charleston area. But once I kind of had an anchor in place, then I just wanted to stay in that spot and keep buying around there as opposed to try to spread myself too thin.
Yeah.
So we just bought the first deal in Spartanburg, and then we acquired a bunch more in Spartanburg and Greenville, and they were great markets. I still love those markets, but they've attracted a lot of attention in the last few years.
Yeah, I was going to say now the rest of the group is after that area as well. I mean, it just seems like it's increased quite a bit as far as population. And we have a property, but it's short-term rental out in North Carolina. But love the area, love the Smoky Mountains. So, as far as your strategy with these multifamilies, were they value add opportunities, or what?
So it was really a mixture. When I started out, I was buying not that long after the great financial crisis, and value add was a thing, but it didn't kind of get to the level of sort of frenzy that it became a few years later, right?
Okay.
So what I really liked to do actually was to buy deals that were already rehabbed. So basically buy them from the value add guys,
mm-hmm.
and then just run them, right? And not get involved in the whole value add process myself. The way before the market just went haywire, value add meant that you went and rehabbed the whole property, right? You didn't go and rehab a couple of units and then claim that you had proven out the value add and then sell it to somebody, so they would do the value add, but you're going to sell it to them for like the post value add valuation, except they have to do the value add, right? What it used to be like was that you would buy, if you were going to do a value add, you'd be buying like a distressed property, like a really undervalued property for super cheap because you recognized the potential there. And then you went and you rehabbed the whole thing. And then you sold it to somebody like me. And the reason that someone like me would buy it was because it was kind of like new construction in a couple of ways. Like one was that here you have this completely finished property,
mm-hmm.
which is great. You don't need to do anything to it. But the other thing is that just like in a new build, when you're doing a lease up from a true value add, you're not charging the highest rents. You're charging enough rents to hit your number, but really what you want to do is get that property filled so you can sell it.
Right.
So there's still a lot of meat left on the bone for the next guy. So I could still come in and raise rents, right? Even though the property was finished, because my incentive as a long-term holder was different from the incentive of value add guy who was just trying to lease it up as quickly as possible. Now that all changed when cap rates got really compressed, and what people started doing instead was, rehab a few units, just lease those units at the absolute highest dollar number they possibly could, and then turn around and say to the next guy, see, looky what you could do if you go and complete the value add. Therefore, you should pay me a lot of money for this property right now, even though the value add hasn't been done. And then, of course, what the next guy did was the same thing. Rehab 20 units, rent them for the next new higher rent level, then turn it around and sell it in 18 months as a value add to the next guy. And I saw, deals trading 4 and 5 times as a value add every single time. And that didn't make any sense to me because I just came from a different background where I was looking at, like I said, sort of buy and hold. But we had a range of property. We had, sort of like C-level deal that we kind of did nothing to. That was kind of a disaster. We had a C deal that we did nothing to. That was fantastic. We had, a B plus deal that did really well, but always trying to buy it, not to completely rehab it ourselves. It was always to try to just operate it as is, and just collect the rents, right? And raise rents as we could, or make it more efficient. I mean, the other thing too is back in the day, there were still a lot more mom and pop operators out there. Right. People who owned one asset, their whole job was owning this 150 unit building that they managed themselves. And their incentive was also very different too. Like their incentive was to keep things easy. So they would not charge the highest rents. They just wanted to reduce turnover because turnover is expensive.
Exactly.
And just make their $150,000 a year in a small city like Greenville, where like that was a lot of money, and not work hard. That was their incentive. So you could buy deals that still, like I said, had a lot of meat on the bone from mom and pops. Now that is pretty much gone because most of those deals have been traded out to syndicator groups who are, trying to extract top dollar for them. But that it was a different market, back in those days.
For sure. Yeah. I'm just curious about, obviously, value adds been kind of, seems most folks that I've been on the podcast and that are doing multifamily do some type of value add play. And, the reasons are fairly obvious for that. It gives you the ability to increase the net operating income once you've improved the property. But when you were buying some of these that were already turned in good shape, and you mentioned a couple of times kind of a long-term play on them, your investors were good with knowing, hey, we're going to be in this deal for X amount of time. And how long did you typically hold them for at that period of your investing?
Yeah, I mean, we told people we're going to hold for 10 years, and that's what they wanted. Because they were like, yeah, what do I want to be churning this money every 18 months for?
Yeah.
They were like, I want to park the money and have it work for me. And so we told them up front, this is a 10-year deal. We wound up selling much sooner than that just because the market went haywire and we started getting offered like way more than we thought the properties were worth. And maybe they were worth more to somebody who really was going to come in and completely gut them again. But, right. But the play really was, I mean, the market has just changed so much. And I think it was, the super low interest rates for so long and the cap rate compression for such a long time really forced people's hands. It became almost impossible as a syndicator to make any money on a buy and hold strategy. And because you were paying so much for the asset that in order to get any kind of return out of it for your investor, you had to basically eliminate all your fees. I mean, not all your fees, but I mean, people were charging huge acquisition fees, right. But there was no cash flow for you over the course of the deal, right? Maybe you'd make a little bit of an asset management fee or something, but really you were looking at the beginning of the deal and the end of the deal and no ability to build like what I wanted to build in the beginning and was somewhat successful at building was deals that were going to cash flow to me so that I could live off that income from those properties while also obviously paying my preferred returns to my investors, et cetera. That you can't do that at 3 and 4 caps. It becomes impossible.
Right.
So what happens is that the market essentially is forced into this churn situation, like what we saw, where it's a value add every 18 months. Somebody's flipping it to the next buyer, and as long as super low interest rates are happening and incredible rent growth is happening, that's sustainable. But you can't last forever, which is kind of what we've seen happen recently. So I think now the market's going to go back to where it was when I started out. It kind of has to. I mean, in some ways, if you think about these like microeconomic forces sort of force operators to operate a certain way, now they're being forced back into, you've got to be a long-term holder, you've got to be a good operator, you've really got to think about your cost structure, you've got to keep costs down, you've got to like minimize your turn. Like, when people were getting huge rent bumps, they didn't care about turn costs, right? Because they were going to get a big rent bump. Now everybody's really concerned about, turn costs, because if you're not getting an enormous rent bump, one of the deals I'm on now, the lead sponsor, my partner on that deal, sent around an analysis showing where it was actually better for them to give a tenant a $50 rent decrease than to have the apartment be vacant for a month.
Yeah. I mean, I could see turning over. Yeah, it'll eat up, the cash flows very quickly. So
so if you're not getting huge rent bumps, it doesn't make any sense. So now the whole focus is on, being efficient, being a strong operator, holding long term, providing a decent return for your investors, but your people aren't going to be out there with 60% IRRs in 18 months like that. That's done, right? So now it's more about putting your money to work for you for a long time.
Yeah. And what over the course of these several years, what have you learned as far as maybe the levers that you can pull to increase the net operating income? Obviously, kind of fine tuning that management. What are some of the things that are sort of your go-to when it comes to that?
Well, I mean, there's very little you can do on the expense side. Right? I think this is one of the things that people don't really understand. There's not much you can do. Turn cost is one. That's like one that you can be really aggressive about renewals and keeping people in and try to minimize that turn cost. But of course, if they're moving for life reasons, there's nothing you can do about it. You're going to incur that cost, right?
Exactly.
But for the people who just might move around because they just want to move somewhere else, or they're looking for a better deal or whatever, I mean, those costs you can minimize. Pretty much all of the big savings that people used to do have kind of been done, like low flow shower heads, low flow toilets, LED lighting. Like there aren't a whole lot of properties where that hasn't already been done. And every once in a while, when you'd come across a property that was just overstaffed and you just didn't need so much staffing. But when you're buying from a syndicator, they've already done that as well, right? So there's not a lot you can do on the expense side. So really what you have to do is raise rents. And if you're in an environment in which there is a supply demand, dynamic in your favor, then it's easy to raise rents. But if you're in an oversupplied situation, or, now we've had enormous rent growth for a long time and tenants are kind of pushing back against the rent increases, you're not really in a position to be able to raise rents. So, you can try to add, when I started out, a lot of properties didn't have RUBS. So that was always a favorite. Like, let's start charging people for water and for sewer. And so that was great, but that's done pretty much everywhere. People can add stuff like reserved parking or covered parking. There are things like that you can do, try to add more services. But, really a lot of that stuff is sort of nibbling around the margins, right? The big one is just rent, if you can increase rents or not. And in some environments you can, and some you can't.
And as far as the various transactions that you've co-GP'd and that Two Bridges has, I know you initially were focused on the the Carolinas. Where's your portfolio now?
Yeah, so it's pretty spread out. I mean, we're in deals in Florida, Georgia, North Carolina, South Carolina, and South Dakota. I'm trying to think if I'm missing anything. Arizona. Yeah. So
okay.
We're pretty spread out. I work with a really small number of GPs who I really trust. I don't, I'm not one of those guys who goes out and raises money for any deal that comes along. there's like 2 or 3 people that I'm willing to work with. So if they have a deal, I'll partner with them. But pretty much that's it. And then I'm focused, like I said, on the hotel side myself for my own deals. So
Yeah, absolutely. I guess before I want to hear a little bit about the hotels and kind of what you're doing with this initial one. That's been a space that I've always had interest in. Don't currently have anything there, but I'd like to at some point. So I'd like to hear about it. But as far as just, I know none of us have a crystal ball, but you've been through the great financial deal back in 2008. You've seen some stuff throughout your career. What do you see happening? With both cap rates, interest rates, and really where do you see multifamily going over the next say 5 years?
I think the Fed has probably stopped raising rates, but I don't necessarily buy into the idea that they're going to start cutting. I know there's a lot of people getting very excited about the possibility of rate cuts.
Right.
But I'm a little skeptical about this because I think that, if you look at the job numbers that just came out today, they're still above expectations in terms of like the number of jobs created and wage growth. I think the Fed is probably very concerned about letting inflation get started again. So I think they're going to be quite wary before they start cutting rates. And I also believe, this is just my personal belief, but I also believe that the Fed understands that they let rates get out of hand for too long. Mm-hmm. So too low for too long. And it created a whole lot of, problems, not just all these asset bubbles, but the housing affordability crisis is directly related to the fact that interest rates were too low for too long. Right. So I think that the Fed is going to be wary about lowering rates too much. And if there is a recession, I think that they will lower rates a little bit, but I think it's for us to see rates super low again, there's going to have to be another great financial crisis type crisis to get them to lower rates to that level. So what I think we're going to see is higher rates than people were used to in the last few years. Mm-hmm. And even if rates are cut a little bit, and even if, let's say, the Fed does cut rates 3 times, like some people believe it's going to do, rates will still be higher than they were at the peak of the bubble, which means that there's going to be a lot of operators who are still in a lot of trouble because they use variable rate debt and they now can't afford their debt service. And the Fed cutting rates will help things a little bit, but it won't help them enough. Yeah. They'll still have to buy rate caps that maybe they can't afford. And that doesn't even address the massive expense growth that we've seen in a lot of markets, or the supply problems, not problems, but the growth in supply that you've seen in a lot of markets as well. So I'm not looking to sort of like, as a lot of people are, like, oh, rosy times in real estate again, where we're just going to go back to flipping in and out of properties and making these huge IRRs and these huge fees. Like, I just don't see that happening. I think what I saw after the great financial crisis was that a lot of people were trying to sell property and couldn't sell it because they were asking for too much, and the math didn't work for the buyers anymore. And I think we're going to be in a situation like that for quite some time, probably for another couple of years, where sellers are going to continue to have either unrealistic expectations about what they can get for their property, or they're going to have no real choice. They're going to be trying to sell properties for more than they're worth because they can't do a short sale, right? Or they want to try to save their investors' equity. And so they're going to be asking for prices that are really out of line with what buyers are willing to pay. So there's going to be kind of like we saw the last time around, a bit of a freeze up in the market for a while. And, but you'll start eventually seeing the foreclosures. And once that happens, then the sellers will start getting very realistic very fast about what their properties are really worth. And I think the market will sort of start clearing at a new level again. But the cap rates are going to have to be higher because interest rates are higher. I know that there are some people who, for some reason, believe that cap rates and interest rates are not related, but I strongly believe that this is just this is a function of math, and you really can't argue with it. The enormous amount of dry powder that was supposed to prevent multifamily properties from falling more than 10% didn't materialize. and multifamily properties are now down 22% from the peak, and the dry powder still hasn't come out of the sidelines yet.
Right.
It's because that money was always waiting for real discounts, not a little piddly 20%. I mean, they're looking to buy distressed at 50 cents on the dollar. That's why it's sitting on the sidelines. So I think there's a lot of people who are really kind of fooling themselves about where the market is and where it's going to go. And I think that's very likely the case because all they know is the market from, people who got into the market in 2018, 2019, they think that's what, they think 2021 and 22 is where the market is supposed to be. But that's just a historical anomaly. And, we won't see that again for another generation until we have a bunch of people who have forgotten about this crisis and they make the same mistake again. So, that's my view. I'm sorry, I kind of went on a little bit of a rant, but
no, that's okay.
I have some strong feelings about this. So,
no problem at all. And I'm glad you mentioned, kind of the tie between cap rates and interest rates. Curious though on so even if we don't see maybe we see a little bit of a break on the interest rates. What do you anticipate on the cap rates? Do you anticipate those continuing to expand or stay kind of where they're at currently? Or
I think that they're probably too low now, given where interest rates are.
Yeah,
because historically the spread between the interest rate and the cap rate has been between 200 and 300 basis points, and because that's just what the buyers need to make money.
Yeah,
right. So we got into this sort of frenzy for a while where that compressed and people were buying at negative leverage or close to it, but it's not sustainable. It only works if you know that, you can sacrifice not making any money for a couple of years because you're going to exit for a big payout at the end. And that's just not historically how the market worked.
Right.
This is what we've seen in the last couple of years of people just flipping like this. It only happens during a bubble at the top, right? This is not normal behavior. And so now that we're reverting back to a more normal market, you're going to have people requiring more normal spreads.
Mm-hmm.
And if an operator knows that big sale liquidity event is not happening for 5 or 10 years, then they've got to make some money in the meantime in order to eat.
Right.
And that means that you've got to have a higher spread so that there's money left over after they paid their preferred return so that they can actually make some money.
Yeah.
Right. So, when I started out, banks require a 1.25x debt service coverage ratio to give you the debt. But when I was starting out, we had figured out that unless the debt service coverage ratio was about 1.6, we really weren't going to see any money ourselves on the deal until we sold. And so that's what we were aiming at. And if you went into a coaching program, in those days, what the standard wisdom was like, you got to buy at 1.5x at least, right? If it's not 1.5x, don't bother with the deal because you won't make any money yourself. And so I think we're going to go back to, there's going to be a lot of people who are either going to learn that lesson and start going back to that, or they're just going to be out of business and they're going to go do something else because they got to eat, right? And so that, and I think we'll just go back to kind of where we were. So I think I think cap rates are going to stay high. There's always fluctuation, but I think the cap rates are going to stay high and probably move even higher because they're just going to have to. The math just doesn't work for a lot of people if the spreads are not better.
Yeah.
But for passive investors, this is better too, right? I mean, they're going to make more cash flow at higher cap rates and higher spreads than they will for them too. If for people who want cash flow, and I know LP investors who were out of the market for a long time because they're like, I need cash flow. I'm a cash flow investor and I can't get any cash flow on flipping deals.
Yeah.
And I don't want to wait 18 months for my money or 24 months for my money. I want cash flow now. And so I think those LPs are going to now kind of be in the ascendancy again. And the folks who want a quick buck are going to go and find something else to make a quick buck in.
Yeah, no, that makes a lot of sense. I agree with you. And I think that they will continue to go up a little bit on the cap rates. Just, I still don't think that they've adjusted enough. There's still a chasm between, what people are still trying to, they're remembering a year ago and thinking, gosh, the value couldn't have come down this much. But in many cases it has. Let's maybe shift gears and go to some of the hotel stuff. And I really, before we go there, just curious, taking you all the way back to your lawyer days. You mentioned in your bio that you represented hotel owners with disputes on national hotel chains. My assumption on that, and I could be wrong, and you can tell me if I am, but is that just, obviously with major hotel brands, they have a standard that they need the hotel to stay at. And is the dispute that they were having is that they're falling away from the franchise?
So there's a lot of different things going on with hotels and chains, right? So I think one of the things that people don't realize necessarily is that, when you go to a Marriott or a Hyatt or whatever, Marriott or a Hyatt doesn't own that hotel, right? It's owned by some ownership group. If it's a really fancy, swanky hotel, it's probably owned by an insurance company or a private equity fund, or maybe some super high net worth individual, a Saudi prince or something like that. Right. But it's not owned by Marriott or Hyatt or whatever. It's either, it's owned by whoever it's owned by, and it's either operated by Marriott pursuant to a management agreement, or it is operated by a third-party management company with a franchise agreement with Marriott, right? And so what happens, because you have divided ownership or divided responsibility, let's say like that, is that on the one hand, you have the owners expecting the chains to measure up to some kind of performance level, right? Because that's the promise. Like, hey, if you give us your asset, we're going to make you this much money. So that's the promise on the one hand. On the other hand, the price that you pay for that as the owner is the hotel chain says, like, you must meet these standards for everything, carpet, drapes, towels, mattresses, toilet paper, like whatever it is, the scent of the cleaning materials. Like, you basically, you're responsible for all of it. Now, if the management company, if Marriott is managing the asset, then that's a little easier because they're just applying the brand standards themselves. But sometimes what happens is you get into the situation where you've got the third-party management, or I guess sometimes you do have, for smaller hotels, they're self-managed pursuant to the franchise agreement. Then you get like conflict with those brand standards. And the thing is, like, those brand standards can be really onerous, right? The hotel can, and I saw this happen when I was a lawyer. The chains can be like, okay, our new marketing thing is we're converting to this new mattress, right, across our brand. Yeah. And you've got 2 years to get new mattresses. And okay, you and your 1,000-room hotel, you now have to go out and buy 1,000 of these $5,000 mattresses, right? And maybe if you own a 1,000-room hotel, that's not such a big deal for you, but it can be a big deal for some of the smaller operators, where suddenly now they're in the situation where they've got to go and spend all this money. And the thing is that the chains have the owners over a barrel, because the financing is always tied to the flag. So if you lose your flag, you lose your financing, and then you're in a world of hurt. So basically the brands have you over a barrel. So it can be very onerous. So what we were doing was we were constantly like in these fights with the hotel brands, where there was a lot of esoteric accounting stuff, but they were like charging the hotels for things they weren't supposed to be charging them for, trying to offload their corporate overhead onto the hotels using various accounting tricks, things like that they weren't supposed to be doing. Or, one big litigation I was involved with, where one of the chains tried to open a new hotel right next to the one that our clients owned. And we were like, you can't compete with us. You're our agent. And they were like, yes, we can. And so we had a big litigation, and, we won. But it was sort of that sort of stuff. So I find it funny that, like, I've come full circle. Now I'm in the hotel business. Right, I never expected to be as an owner, but But anyway, I mean, I'm happy to. I'll take a break now so you can.
Well, tell me about this. How did you get into the one that you bought up in the New York Finger Lake area?
Yeah, so we have two now actually, but the first one that we did really was almost accidental. During COVID, my wife and I bought a house up in the Finger Lakes where we always vacationed, and just like a lot of people in the city, just we needed someplace to get out to. So after we bought this house, we would have to pass by this hotel every time we drove to our house. And every time we drove past the hotel, we would say, wow, look at this. I mean, this kind of rundown beat up old hotel in this amazing location.
Mm-hmm.
I mean, this place has like spectacular lake views, right? And every time we drove by, we'd be like, man, somebody ought to do something. This is really a shame. So one day I was poking around on Crexy or LoopNet or something, just looking, I was curious, like what kind of maybe small multifamily was up there that maybe I could buy on my own or just, have one or two partners do it with some buddies or whatever. And I came across this hotel for sale. And I was like, okay, this is interesting. And they had kind of cut the price, and been on the market for a really long time. And I thought, okay, somebody ought to do something. Maybe I'm that somebody. So I went and I found, through one of my partners on another business deal, turned out that his cousin has a hotel management company. So I consulted with him, said, hey, what do you think about this? He liked it. He had done some similar kinds of turnarounds with other kinds of, these small independent hotels. And he said, I think this is a good opportunity. So I went to one of my investors and said, hey, would you like to do this deal? I'm not going to go syndicate this. I'm just going to, if you're interested, let's do it. He was interested. So we did it as an all cash deal. And we finished up the renovation on that this June.
Okay.
And so that's been going great. And we just closed on a second hotel up in Vermont in November. So we're deep into the renovations on that. And I just really love this space. I mean, one of the things that I noticed was that it reminds me of multifamily when I started in multifamily. There's a lot of independent hotels that are owned by mom and pops.
Mm-hmm.
They really are true value add opportunities where they need a lot of CapEx. They're really underperforming their potential because they need a lot of CapEx. And usually these families don't have, they're running them kind of on a shoestring. They don't have a lot of additional capital to put into them. So over time, they just sort of get, run down. And we're able to come in, bring in, modern systems, modern technology for reservations, the CapEx, obviously, that the hotels need. We put them through an entire design process and basically relaunch them as a boutique hotel. And it's really fun. But there's also a lot of opportunity here because there are very few people who want to take on a hotel value add project. They're very frightened by this prospect. So the market on the buyer side of this is pretty limited. Once you have a fully renovated hotel with proven numbers and you've stabilized it, now there's a much bigger buyer pool who is willing to take that on. And some of them might even be appropriate for putting a flag on, which makes it a lot easier to finance the deal as well.
Right.
But yeah, I see a huge opportunity in this space, especially as the hotel, the age of the people who own these hotels. These are all baby boomers, or maybe even older than that, and they really need to sell. Their kids don't want these assets. The kids have moved away. The kids grew up in the hotel business and don't want to work 7 days a week in a hotel. And they need to basically be professionalized. And there's not a lot of people who can do that who can sort of transform them. But we have that expertise, from the multifamily business and my partner being a second generation hotel guy. We have the ability to inject the capital needed and to, rehab these properties. And we do a, full gut renovation, soup to nuts on these assets and just change them into something new. But what we look for is things that are really well located, like just, unbeatable locations, just with assets that are not matching the location anymore.
Okay. And the one that you have, obviously you mentioned the Great Lake view on the one in the Finger Lakes, but what about the Vermont one? Is that located in a touristy area, or what are some of the attributes that you found attractive about that one?
Yes. So that hotel is it's located in Bennington, Vermont. It's the only hotel that's walkable to downtown. So it's the only hotel in town where you can walk to the shops and restaurants from the hotel. It also has really generous room sizes. It's got very unique kind of mid-century modern architecture, and it has beautiful gardens. And so all the competition in town, either it's like a roadside motel with a view of like, if you go to the pool, you're looking at the Midas, across the street,
Right.
or your view out of your hotel room is like the Hannaford parking lot. What we have is views of beautiful, lush gardens, very isolated and not isolated, but very private, and so it's a very different experience for the guests. And as I said, you can walk to downtown. So that's why we like that asset, just the unique location in the market. So it doesn't have the views that the other one, has, but it still has something special in that marketplace.
Yeah, that's cool. That's one thing with hotels and different things that it's just neat to be in areas where you wouldn't mind going and visiting your asset,
Right, exactly.
So,
yeah.
well, cool. And so do you think over the next 5-10 years, you're going to continue to focus on kind of the hotel space or?
Yeah, I mean, I'm still involved in the multifamily space, especially on the capital raising side with these partners that I mentioned. But I really do love this hotel space. I find it, there's just so much value to be had here. That's what excites me the most about it. But I also really like the creative process of the design. It's a lot more design intensive than multifamily is.
Yeah,
and because you really have to think about sort of like the guest experience, and then you can add amenities to these things. It's a very interesting process. And then, the project of trying to create a brand is also really fun. And that's something that it's harder to do in multifamily. I know some people have tried, but it's a lot easier to do with a hotel than with apartments,
Yeah, for sure. Well, that's really neat. And I know we've kind of blown through some of our time here, and want to be able to get to a couple of questions I ask every guest. But Jonathan, if somebody wanted to find out more about you, learn how they could possibly invest with you, where would be the best place for them to go?
Yeah, the best thing to do is just to Google Two Bridges Asset Management LLC.
Okay.
And so if you Google us, we'll pop right up. There's an investor page where you can go and fill out an investor form, and that will just start the process for you. Then fill out, and my assistant will be in touch.
Okay, perfect. Sounds good. And I've got a couple questions, Jonathan, that I ask every guest. And the first one really is, if you were to give some advice for somebody who's maybe just starting out their investment journey, what advice would that be?
So my advice really is to get started. Like, don't get hung up. I think a lot of people, especially in the last few years, got very hung up on the idea that they needed to go big fast, right? And so the problem with that is that you're just butting heads with a lot of people, and you also just need to raise a lot of money, and then you wind up in these deals where you've got like 20 co-GPs, and it's kind of a mess. I would say start small, but get started, right? Start with what you can bite off and chew yourself, or you and a couple of partners, and just get moving, because that's where you get the experience. The other thing I would say to somebody starting off is don't try to do it all yourself. Like, this is people say it's a team sport, but they often don't say why it's a team sport. And the reason it's a team sport is because it requires a bunch of different skill sets, and those skill sets require very different personality types. And nobody has all of that stuff. So, like, if you're the person who loves sitting, fiddling around with a spreadsheet and underwriting deals, you're probably not going to enjoy talking to investors all that much. And if you're, the person who really likes to go out there networking and talking with investors, you're probably not going to like sitting behind a computer and looking at a spreadsheet. So you really need to figure out, but both of those things are absolutely necessary, right? So you really got to figure out what piece of this you like, and then find people who like the other piece and partner with them.
Yeah, that's great advice, both of those. How about book recommendation? Anything? It doesn't have to necessarily be real estate related, but just something you've read recently that's been impactful.
Yeah, I mean, I read a lot. So one thing that I really, really liked is Who Not How by Benjamin Hardy. That's been really impactful on me. Just the whole idea that a lot of people don't start projects because they get hung up on, well, how do you do the project? Where they really should be thinking about who could do this for me or who could do this with me.
Yeah.
Who's got the expertise already, as opposed to me trying to figure it out. That was really eye-opening. So that's I'll just leave it with that. That's a great book.
Yeah, for sure. I love that one. All right, Jonathan. Well, really enjoyed our time together here today. I apologize that we ran a little bit long, but it was very interesting and didn't even get to everything I was hoping to. So appreciate you being on the Wealth Flow.
Yeah, it's all because I just couldn't shut up. So, but anyway, thanks for having me on the show. I really appreciate it. It's good to get to meet you.
Yeah, thanks, Jonathan.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.